Hi, I'm Russ Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by technical strategist Todd Sohn to talk all things markets. Todd, how are you doing today?
Hey Ross, I'm great and nice to speak with you as always.
Great to have you here and get some of your insight. Let's start 30,000 foot view. We're about a month off of the October lows in the stock market. And, it's been a nice rally, but it's been choppy, it's been a little volatile, and it's been kind of a split market. So I wanted to just turn it over to you and get your high level thoughts on what you've seen and what that might mean for where we go from here.
Yeah, great question. And I would keep in your tune with the high level view. The market is still in a downtrend, right, across the board. But you are seeing some subtle leadership occurring and to your point on the split market, right? The Out of the 10 largest names, the more tech and growth oriented names are the ones that are down. But when you look to the more value side, say from healthcare, industrials, and financials, those are the names that are up, right? And so we continue to see this leadership shift from tech and communications, which led really over the last decade, and more so into energy, financials, industrials, portions of healthcare. There's this regime change that continues to occur. And I don't want to lose sight that you may get some mean reversion here into the final weeks of the year. The fourth quarter is typically strong. There's a mean reverting effect to chase beaten down names. But keep in mind, the best trends are still found from those other sectors I was just talking about in terms of leadership. That's where you want to continue to focus for where you want long exposure.
So I think that's really interesting. I mean, people are, after the last decade, conditioned to expect growth in tech to really just bounce back at some point, as soon as the Fed pivots or as soon as rates head downward. But does the leadership from energy and value and industrials, does that feel like it could be a little more structural, that it might, maybe not have the kind of decade run that tech and growth just had, but also isn't necessarily just a flash in the pan? I'm curious where you land on kind of the sustainability of those sectors.
Yeah, and I think a helpful comp, historical analog, and it's a little extreme, is going back to the tech bubble, right? You think about tech really went through the ringer there, and it took years before that sector, A, recuperated on an absolute basis, and B, took a leadership role. Just because the sector bottomed in 2002 or early 2003, on a relative basis, it continued to underperform for the rest of the decade, really, until after the financial crisis. So I think that's reasonable to expect that tech is going to take the back seat of leadership here over the next couple of years. And while energy and industrials and financials assume the more leadership role that they took post the tech bubble. And I also think it's interesting when you're looking at some of the names from the tech bubble, Microsoft, Cisco, they all had very difficult and drawn out declines. But there were stocks that did go up on an absolute basis in that environment. Names from the aerospace industry, from insurance, from food and beverages, from healthcare. So just because the market may still be in a downtrend based on what some of the sector weightings have impacted here, there are still stocks that we're going to find that they're going to continue to rise, and you're seeing that reflected in our relative high list via those groups such as insurance, machinery, aerospace and defense, food and beverages. So I would still look there away from the tech space as we are going with this mantra: years, not months. Continue to keep that in the back of our minds from a high level.
I think that's really good advice. Let's shift for asset classes from stocks to something that we get questions about kind of off and on, which is gold. And you all have written about gold a little bit in the past week. I think there are some who will wonder why it hasn't worked better as an inflation hedge, but it has been, a difficult rate environment for something like gold. So, as we stand today, what are you seeing out of gold? How do you feel about it heading into 2023? What do you think about that?
I think the most supportive data point for gold is that you've seen pretty heavy outflows from gold ETFs. That would suggest that investors have thrown in the towel on the metal, right? And we like when assets have a supportive sentiment backdrop via those ETF flows. And then when the asset starts to exhibit some sort of momentum, you've had a hint of that over the last few weeks. So that creates a nice little contrarian setup for gold. I think if you're looking for exposure away from stocks, and bonds are still having a tough time too, gold may be worth a slice of your portfolio. I would keep an eye on the 1700 level. That's important resistance. We may climb through that today pretty sharply. And then that should be the spark needed to help get gold sustainably higher. Again, I think the sentiment backdrop is the most supportive data point. Gold flows nowhere near aggressive, right? They are much more supportive from the contrarian idea. And again, keep an eye on 1700, and it's worth a slice of your asset allocation if you're looking for something away from mega cap growth stocks. And again, bonds still having a difficult time here too. So we think it's an asset that can continue to work into 2023.
That's really great insight. Todd, I appreciate your time. We always leave with a few actionable ideas, so that's really valuable for our folks. So thank you so much, and hope to talk to you again soon.
Thanks, Russ. Hope to speak to you soon as well.